Hello, this is lecture 11 of my online course, Mastering Personal Finance, debt, debt consolidation options that don't hurt credit. You have a variety of options for consolidating your credit card debt. All of these will be good for your credit in the long term if you are conscientious about making payments. Credit card balance transfers. You always have a chance to get companies to give you a new credit card that contains a balance of the old one. Balance transfer credit card typically have a zero or low interest rate for a particular promotional period, say 12 months. It can save you money on interest and help you pay off your debt faster. When transferring balances, the credit card company typically charges a balance transfer fee, often 3% to 5% of the amount transferred. So if you transfer $3,000, for example, you could pay up to $150 to maximize savings with a credit card balance transfer. Pay off the card before the promotional interest rate expires and the new, likely much higher rate kicks in. While it can be tempting to close credit card accounts once their balances are paid off, it can hurt credit scores since having fewer open credit accounts can increase overall credit utilization ratios. Credit card debts can be consolidated within a loan. If you are not inclined to take out a new credit card or don't qualify for a good one, consider applying for a loan to consolidate your debts. To get the most benefit, you will want to shop around for an interest rate significantly lower than you currently pay on the debts you plan to consolidate. Your options include a personal loan or a debt consolidation loan. Both are personal loans, but debt consolidation loans are intended for that specific purpose. A homeowner can be eligible for a home equity loan or a line of credit, HELOC. The former comes in a lump sum you pay off over time, and the latter is credit line you can borrow against as needed. One can meet with home equity loans and HELOCs is that your home secures them and your lender could foreclose on them if you cannot keep up with the payments. By contrast, most personal loans are unsecured as most credit cards. Debt management plans. Debt management plan differ from debt consolidation but can achieve a similar result. You can get them from a non-profit credit counseling agency to reach an agreement with your current creditors to get lower interest rates. You then make one monthly payment to the agency, which in turn pays your creditors. Paying off your debt with a debt management plan could take 3 to 5 years, depending on the amount of your debt. Participating in debt management plan will not affect your credit score. That is what the National Foundation for Credit Counseling says. When FICO determines your credit score, it will not consider the note in your credit report saying that you have entered into the debt payment plan. Overhauling your budget and spending habits. The easiest way to minimize harm to your credit score and save money on fees when consolidating debt is to make a budget for paying off and sticking to your debt. Look for opportunities to trim optional expenses such as dining out and entertaining and reduce required ones such as housing. Also consider your options for earning more money, such as working a second job or selling some possessions you no longer need. Apply those funds to your debt to pay it off faster. Factors to consider when merging credit card debt. While several debt consolidation methods exist, only some are right choices for some situations. So consider the following factors before choosing your debt consolidation plan. Interest rates and fees. Compare each debt consolidation method's interest rates and fees to see which offers the best savings. Remember that the lowest rate may not provide the best savings when considering interest rate. While one method may have a low interest rate than another, if the payment term is longer, you could pay more interest over time than a higher rate for a shorter term. Repayment terms and duration. Check how long each method will take to pay off your debt. For example, a personal loan might take 3 years or more. If the financiers help you to have a credit card balance transfer offer for 18 months, that might seem like a better option, but it will only be if you can pay off the balance within the last 18 months. If you can't, you may pay more interest on the credit card than on the loan. You must think about the repayment terms. With the personal loan, check to see if there is a prepayment penalty if you want to pay off the balance early. That penalty would negate any savings you could receive by paying the loan full before the due date. I hope you like this video and find it useful as well. Thank you very much for watching the video. Thank you. Bye for now.